and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. As you know, Revenue Rocket is the world's premier growth strategy and M&A advisor to IT services companies. With me today on today's podcast is Ryan Barnett, my partner. Ryan, how are you?
Hey, Mike, I'm doing well. Thanks for having me on here today. Now, in our work, we are M&A advisors for IT services companies. So we work with managed service providers, application developers, channel partners, cybersecurity firms, and anyone that really offers a service that's affiliated with technology as part of their offerings. We do a lot of work in this market. In order to be a successful M&A advisor, you really have to understand the valuations that happen in this space. And as part of our work, we're always doing valuations. Every day we're doing another valuation for another firm. And what we want to talk today is what's the difference between a valuation that you may conduct on your behalf compared to a valuation that may be done for an open market, and why that's important and some things to consider. Mike, you brought up this topic today. I'd love to hear a little bit more about what's on your mind, and let's just start really, really big level. What is evaluation, and why is evaluation for an IT services company important?
Yeah, sure thing, Ryan. I think most people that start IT services companies generally begin with the end in mind. They think at some point they're going to exit it. Tech-enabled services companies, IT services companies are very, very rarely passed down from one generation to the next versus other types of businesses, which often are. Manufacturing companies oftentimes are moved from one generation to the next. Specialty retail. I think of hardware stores and sometimes, quick serve restaurants, things like that are oftentimes multi-generational in nature. And so because IT services companies are not, understanding the value of that equity as you continue to build and grow the firm is super important. That's typically provided by a firm like Revenue Rocket, who does outside valuations, who has expertise in the market, understands the comps, just like real estate comps. Companies have comps based on their profile, and understand and have a team that facilitates these valuations pursuant to both what we would call open market transactions, where a buyer is someone other than someone involved with the business, or in some ways in what would be a trade inside or within the partnership of the equity that's owned. And so those valuations and how they play into the building of equity, how you manage them is probably part of the single largest asset in your portfolio, asset portfolio, or your portfolio wealth is important.
If I look at this at a holistic level, the valuation is going to be essentially the value of the entire business and what it's worth at a point in time, based on the financial performance of the firm relative to other firms that are in the market here today.
That's
Is that
great.
all right? So if we've got a valuation established, and why would a firm look to have a valuation done when it's internal facing? We work with a lot of companies that have a variety of ownership structures, including multiple partners. That seems like if you have multiple partners, you'd want to have them all on the same page of what the value of the business is, right? But tell me, why is it important for a company to have an internal facing valuation?
Yeah, I would say that, not vastly different than your stock portfolio. You want to know what, that those equities are worth. Certainly your equity in the business, whether you own all of it or a portion of it, you want to know that too. And the way you do that is through evaluation. Oftentimes we have clients, since we do a lot of these valuations on a monthly, quarterly, yearly basis, seek to get one done annually, just for their own sort of portfolio management. What is the business worth? What percentage of that do I own? How should I, consider that equity as part of my own net worth as an individual? Likewise, it can be used as a tool to implement a best practice around corporate governance should there be a transfer of equity in the coming months or year. We certainly strongly encourage our clients to do an annual valuation so that at a minimum, they can talk about how effective they're executing on their growth strategy and growing the business. Value is certainly a great bellwether and a measure for determining if you're executing well. And it provides a great context for a discussion with your partners about, are we making the right level of investments? Are we realizing a return on those investments pursuant to our kind of return on the equity that we have in the business? But more importantly, if you have multiple partners, I think it's critically important to be able to have that valuation done, not only to help shape the way you plan to invest and grow the business in the future, but also to understand how, effective your strategy has been in the past and to formulate any potential equity transactions with those partners that will occur in the coming year. A best practice, and you certainly can talk to your corporate attorney about this, but is to formulate a valuation on an annual basis so that you can bake in a sort of trading price or methodology into your buy-sell agreement or your shareholder agreement with your partners. And if you do that effectively, then should someone unfortunately unexpectedly die or have to exit the business for some reason, you can have a context around, how do we fairly transact the deal with those equity holders with a schema that can be easily executed. Certainly, that would be considered a best practice and a good business case. Also, a good reason to do an annual valuation of your business.
And I just want to emphasize the point, Mike. I think you nailed it. You have to have a buy-sell agreement in place, and you have to be able to work with those agreements and those partnerships. And part of that can be a matter of in those agreements saying there is going to be a valuation done on a periodic basis. Um, Mike, if assuming that company is going through evaluations and they are using it for an internal documentation to help facilitate the transaction kind of between internal parties. How do the results of that valuation differ compared to that if you're in an open market or a third party M&A transaction?
Yeah, good question, Ryan. So, an arm's length transaction where there's multiple bidders to sell your business, well, there'll be a number, there'll be a value for that. And primarily that value is driven by three things. There's a financial analysis of the business pursuant to how the business is performing. And that's generally based on a multiple of your profit or multiple of EBITDA. There's certainly a comps, if you will, sort of analysis that says, hey, here's similar companies to mine that have traded, successfully done transactions in the last, let's say, period of time, could be as short as a month or as long as probably 6 months. And those are used as sort of another data point. And then there's your discounted cash flow analysis, which has to do with, discounting your forecast of cash flows back to today and discounting those for risk. And I think all of those three data points then coalesce around a number that should be pointing at what would be considered fair value in an arm's length transaction. Um, Now, if you're going to do an internal trade with your partner in a business, typically those deals trade at about 20% discount, give or take, to an arm's length transaction. And that's typically what we've seen in the market. And generally, if you go to any, authority around valuation and they're doing a valuation for your firm pursuant to an internal trade, because of what we'll oftentimes call a limited market trade, because there's usually one buyer and one seller, which is the corporate, the stockholder is the seller, and the buyer is the corporation or you as a partner. Um, Individually in the business. It's generally a guaranteed payment, cash type payment or seller note, combination of both could still be appropriate. And, it's just not a competitive environment. I mean, you're coming to a number that, is going to work for everyone with a limited competition. That deal will trade about 20% discount, and that's typically what we see in the market.
So things like the open market ability to attract more buyers is going to press that valuation up. So the buyer pool is going to be higher. your EBITDA multiples may even be higher based on the methodology that you're using. As you may, if you're transferring wealth to a shareholder, you may not want that price to be as high if you come to some kind of agreement with that. An outside market will likely just pay more because there's for that strategic control compared to an inner person, and then just the funding of that deal. So competition always drives more deals up. If it's just internal only, I can see why that's going to be a bit lower. Mike, when you think about this, is there a what kind of companies can provide valuations, and is there any kind of regulations or regulatory bodies that deal with valuations that people should be aware of?
Yes, so certainly valuations can be provided by your accounting firm. They have the appropriate trained staff to do that. Some of the challenges with using an accounting firm typically is they have limited experience in your market. They certainly know how to do the value of the cash flows and a DCF model, but don't necessarily have exposure to private transactions, which certainly can flavor a deal, and I think in many ways are some of the most important components of a valuation, as you can imagine. There's M&A advisors such as ourselves that can do valuations because we do a lot of them pursuant to our client work, particularly in representing buyers to the market. We're always looking at potential sellers and valuing their business, trying to get transactions completed. Or if we're representing a seller, we need to establish a baseline valuation in order to bring them to market to understand kind of what market-based price is. Um, there is some authorizations and certifications in the valuation space. There's an authorization called a certified valuation consultant. And essentially what that is it's a day-long seminar, maybe a 2-day seminar, I guess, as much as 2 days, depending on the certifying authority, to just discuss these approaches that are what are considered normative. It is not required to do valuations. I think as a practical matter, most M&A advisors and valuation consultants and accounting firms are not CVAs or certified valuation analysts, certified valuation consultants. But certainly that's another way to evaluate whether someone, has done valuations in the past. I certainly think a better measure to determine a firm's ability to do valuations is how experienced are they in your space? How many have they done this week, last week, in a month, quarterly, or annual basis? And pursuant to what? Were they pursuant to real M&A transactions or standalone valuations? I think in many ways, valuations that are supported or support M&A transactions because they're vetted against willing buyers and willing sellers are of the most value and can certainly um, allow that person doing the valuation to bring that experience to bear in valuing your business in a meaningful way.
Yeah, that all makes sense, Mike. That industry expertise has got to be paramount. The technical ability to actually be able to do the work and understand the data that you're seeing, and the really the industry experience with other firms that are similar. It's not something that's easy to come by. I mean, you have to actually be in the work and doing the work in order to have that expertise to go there. Um, this all makes great sense. Mike, if what advice can you give to people for just that periodic valuation and what other thoughts might you have on this topic? I know it's pretty condensed here, but would love for you to kind of hear any other thoughts you've got.
Yeah, I think it's always a good idea to understand the value of your business, especially if you've grown it materially since the last time you've done that. I think a best practice is to do evaluation annually. Certainly understanding where the business value is now will formulate your strategies coming up in the next year. And if you get in a rhythm of doing it annually, it makes it easy as an input to your strategic planning process. Not to mention the fact that if you do that, it can support a buy-sell agreement. if you architect with your lawyer a buy-sell agreement that talks about how shares will be traded internally as it relates to either a multiple of profit or some other mechanism, or supported by that external valuation is probably the best way to do it. It will allow you to move quicker in the event of, like I said, a need of a shareholder to exit, or unfortunately someone dies unexpectedly, or maybe they need to sell that equity in support of a divorce or some other personal situation. You're going to be able to move much more quickly and likely more cost effectively if that buy sell agreement is lined up and you have your annual valuation done. Not to mention, the value of doing an annual valuation also supports any potential validation of offers that might come over the transom or be non-solicited. Someone calls you and says they have an interest in buying your business. Understanding the context of kind of where the business is valued and has been valued more recently can formulate vetting whether someone is serious or whether they're just kind of lowballing to try to acquire your business. And certainly having papered evaluation at least within the last 12 months will help formulate those discussions as well.
And there seems like there's no other simpler scorecard than the value of the business. And if we look at companies that are doing well and the valuations are increasing, that's because their revenue and profit are increasing. So the higher the better the company is doing, the better that valuation is going to be, and that can be somewhat just the simplest measure there is.
Absolutely, absolutely. And I think, again, keeping in mind that, most of our clients, the value of their business is their single largest asset. And, managing that, having keen knowledge to what that asset is worth, where a transaction may occur should you need or want to sell that asset, or how you might trade amongst equity holders of that asset, I think is always, certainly a good move in just being prudent with financial management.
Yeah, that makes sense. Well, Mike, this is an interesting topic for today. I appreciate you digging in. Leave it to you for any closing thoughts.
Yeah, sounds good, Ryan. Thanks. With that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. Encourage all of you to tune in next week as we share more sort of tips and tricks of M&A and the world of tech-enabled services, as well as unpack winning growth strategies that we're seeing working in the market. With that, make it a great week. Thanks a lot.